Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me for this episode is Luke Oliver of KraneShares, and we're going to talk about the carbon markets.
Every ETF has a story, and some of them deserve to be told. ETF Stories from Resilient Advisor brings you some of the most interesting stories from the world of ETFs. Learn more by visiting etfstories.com.
This episode is part of the ETF Stories series on the Resilient Advisor platform. If you're interested in hearing about other ETF stories, please visit etfstories.com. That is etfstories.com. Joining me today is Luke Oliver, Managing Director and Head of Strategy at KraneShares. Luke, thanks for coming on.
Thank you, Jay. This is a great resource for advisors, so I'm glad to finally be on here.
Well, I got to tell you, I've been excited for this episode in particular because I know nothing about the market we're going to talk about. You know, I joke with portfolio managers and product developers sometimes. If you were a large cap growth manager, I wouldn't even have to prep for the show. For this one, I tried to prep, and quite frankly, I found it a little bit overwhelming. So let's start with the carbon market and why advisors need to consider the carbon market as it relates to investing.
Sure, and I think it makes sense to go right back on the carbon market. And this is a market that's been growing very rapidly, and there really isn't a lot of ways for investors to get access to the market. And you know, this fund is exactly that. So the carbon market, we really are talking about carbon emissions, greenhouse gases, and what we're talking about is the fact that we've got this growing concern that through the generation of power, the various industrial processes, we're creating a lot of carbon dioxide. And at this point, the carbon dioxide that's being generated is greater than what the Earth can naturally absorb through the oceans, through the growth of trees, and so on. So we're accumulating these gases, and those gases are creating global warming. And this shouldn't be a controversial topic at this point. So something needs to be done to cut those emissions, and something is being done. And the solution is actually a free market solution, which is very interesting. And what it seeks to do is put a price on carbon. And so by putting a price on carbon, you start to change people's behavior. You make something expensive, they start trying to figure out ways to avoid that expense, or greener alternatives start to look more reasonable and more attractive as the cost of traditional emissions and the price of carbon goes up. So how do you put a price on carbon is really the question. So these programs have started up in various markets. Europe has been a leader on it. California was an early adopter of it, as is the northeast of the US. China is coming out of a pilot program and will be one of the biggest, if not the biggest, carbon programs out there. And these are we call these ETS, emission trading systems, or cap and trade, you might have heard of. So the idea is to create a free market. These jurisdictions put a cap on the amount of carbon that can be released in their jurisdiction, and then they sell those allowances into a market where both hedgers and speculators and the entities that need these allowances for their emissions can trade them, and you get a free market price that keeps you under this cap. There's big fines for going over the cap, and it creates this market price. And as that price rises, so do the incentives for people to emit less. And the key to this is that each year that cap gets lower and gets us on target to getting to our, the Paris Agreement, and various other specific different jurisdictions have some very aggressive targets to cut emissions. So that's how it works. We're creating a price that is structurally designed to rise over time, that allows the participants in that market to find alternatives and invest in those alternatives.
All right, so Luke, you're going to have to talk to me like I'm an eighth grader. So who's setting these caps? Who's fining? Who's paying? For somebody that's a novice to the space, walk us through that mechanism.
Sure. Yeah. So let's take Europe, for example. It's the largest, most liquid market right now. So the European Union sets a cap. So right now they preside over about 2 billion tons of CO2 emissions. So think about that. They want to put a cap. They actually want to cut that by 55% going into 2030. So in order to do that, they cap and schedule out a reducing cap between now and 2030 and beyond. And then they have an auction And so all the companies that pollute, whether it be power companies, things like agriculture, things like cement production is particularly bad for emissions. And these companies then will purchase these allocations. So with these allocations purchased, they will then be able to either come in below that and be able to sell some of those to other companies that need them, or they'll come in above that with their real emissions and have to buy more from the market. So this secondary market is created for these emissions that were initially allocated through the auction. Now, so like I mentioned, a cement producer will need to buy these carbon credits. Now, what happens is, by making this a free market vehicle, you get all the benefits of the market. So you get price discovery, you get allocation of resources, and you also get risk management. And that's where this market kind of takes it up a notch. And it's not dissimilar to some of the commodity markets, where then you have a futures market that trades these emissions. So if you buy too many, you can hedge with the futures. If you buy too few, you can hedge that with the futures. And that management of the ecosystem creates this carbon market. And to put some context into this, the futures market now is 280 billion in size across the three major markets that are out there, which are Europe, California, and the Northeast.
Europe, California, and the Northeast. Okay, so again, at a basic level, if you're in California, you have a concrete company. Are you required by law to purchase these credits?
Yeah, and you're right that to bring that up. That's exactly the key. These are mandatory programs. There are some optional programs where people invest in reforestation or preserving forests, and that's almost like a soft carbon offset, but that's not mandatory. We're talking about the mandatory programs. And so each jurisdiction's a little different in what's included. So in California and Europe, it's all industries above a certain emission level, whereas in the Northeast, it's just energy companies. It's just energy production, though that could, as they add more states, it could also add more industries also. So to your example, cement company buys carbon credits. At the end of the year, they show and are audited on what their emissions were and must provide those emission credits. And each credit is 1 ton of carbon dioxide.
Excellent. I have a much better understanding now. So this is very specific right now to Europe, very specific to California, and then energy companies in the Northeast. The capitalist in me thinks, well, those markets could roll out to other places as times change, increasing this market and then the opportunity. So let's talk about the investment thesis then, on how you could, as an investor, more importantly, as a financial advisor building portfolios, allocate to the space. So what is the general investment process for the product that you guys have in the market, which is symbol KRBN?
Sure. So I think there's 2 parts to this. There's what is the opportunity in terms of performance and price, and then how we actually build this. Do you have a preference on where I start?
No, please. You take the lead. I'm learning here.
Okay, so we talked about those 3 markets. In fact, those are just the 3 markets that are large and liquid enough for us to currently access. I mentioned China has a huge market. They would be presiding over about 3.3 billion tons of carbon dioxide versus the 2 I mentioned for Europe. So just to put that into context, much bigger market. And we also see New Zealand, we see the UK, we see programs in various jurisdictions. So this continues to grow. If we have this conversation again in a year, I imagine there'll be many more markets we talk about. And it's interesting you mentioned, could that company move somewhere else to avoid that? Well, that will be baked into the cost. What's more expensive, the carbon credit or moving the facility somewhere else? And so that's what goes into this free market pricing. So what we did, and we worked with climate finance partners, CliFi as they're known, fantastic resource. These are an impact investment company that are just second to none in their expertise in this underlying carbon market. So we worked with them to create the IHS Market Global Carbon Index, and that brings together. It's dynamic. It will bring together any markets that meet the liquidity thresholds, but right now it's those 3. And so we're creating a blended global price for carbon. And that's what KRBN invests alongside. So right now, that's about 65% EUAs, European Union allowances, about 25% California allowances, CCAs, and the about 10% the Northeast, which is called RGGI, Regional Greenhouse Gas Initiative. And that takes, that's the states that I mentioned, from Virginia up to Maine, plus Pennsylvania coming in. So they're the three markets, and this really is like we launched this last summer. We've already had 300 million come into this fund. This really is like a watershed moment. This is the first ETF that gives access to this global price of carbon, and it's the first time people have been able to add this to a portfolio.
Yeah, for folks watching this as opposed to listening, I'm throwing up a couple of charts on the performance of the ETF. But that aside, I'd really be curious about that index construction methodology that you're mirroring. Is it 100% rules-based, or is there an active management overlay? And then how will that evolve and iterate as the markets change?
Sure. So if we look at the construction, it's relatively simple. It takes those three positions, expresses those through the liquid futures in those markets. We end up holding two different Californias, two different European futures, and then just one for the RGGI exposure, the Northeast exposure. So it's quite simple, and we replicate that as closely as possible in the ETF. The ETF itself is active, so it has some flexibility around how we implement that, but the objective is to stay very close to that benchmark and provide that sort of beta exposure to this carbon price.
Okay, so rules-based generally, with some active management on the fringes. Then the index, as it evolves over time, when new markets come online, it sounds like there's some liquidity thresholds that the market would have to have before it got added. Is that correct? And what else would be involved in another market being added to this index?
Yes, well, it'd be quite relatively simple. As a new market comes in, and this would be the index provider's decision to do so, but the intention is for this to be dynamic. So if China were to come along and were as big as Europe or bigger than Europe, and they had a liquid futures market that would allow us to implement, the index provider would likely make that allocation, and we would just rebalance into those other markets. And what I like about that is it means we'll always be rebalancing into more nascent markets where potentially the biggest growth is. So if we look at the performance you showed, a lot of that is coming from Europe, which has really had some great growth. In Europe, they're at 54 euros per ton. And this is quite interesting because California is about $18 a ton, and New York and the Northeast is around $8 or $9 per ton. So these markets are all at different places, and there's lots of room for growth. So we've seen big growth in Europe, and still plenty of upside there. Happy to talk about kind of where people think this price is going. But yeah, there's still some big growth potentially in those smaller markets. And as we add new markets, those markets will generally come in at lower prices and have potentially more upside.
All right. So when I think about a financial advisor building out a portfolio, looking at this as a potential allocation, it's easy to look at the performance and get attracted to this as a potential allocation. But at the end of the day, an experienced portfolio manager knows there are risks out there. And how do we figure out what those risks are? And then how do we monitor them on an ongoing basis?
Yeah, well, so there's three questions I've had on risks with this fund, and it's I'm glad you asked, because I'd love to discuss these and make sure people understand these three factors. One of them is people say, by investing in KRBN, am I betting against the earth? Like, does this mean if I win on this trade, the earth has got worse? And it's almost the exact opposite. Carbon is structurally designed to rise in value over time as the cap is reduced. And so as that rises, the price of carbon rises, you're actually making it more expensive for pollution, and you're cutting arguably pollution, and you're increasing investment in green technology. So as the price gets higher, the world should be getting better in line with that. So I think this is a constructive thing and not a pessimistic position to put on. The second one is people say, well, what if tomorrow they invent a carbon capture technology that just solves all of this problem? So if that happens, certainly the need for carbon allowances might drop pretty quickly. That's fair. However, that technology doesn't exist right now, and it needs investment and it needs time. Various commentators have put that at 5 to 10 years away from even getting close to that sort of technology, and it needs a lot of investment. Again, that's a constructive point with the carbon markets, because a rising price means that the agencies running these auctions are earning more in those auctions that they then funnel back into climate initiatives and funding for this kind of research. And as that price gets higher, companies start looking for alternatives and start investing more in those alternatives to find that technology. So I like to say that the carbon market is the new technology that is going to drive the technology that will reduce carbon. So the short answer to that is we don't see that as an issue unfortunately, it's not going to be an issue for some time, but the rising price of carbon supports finding that green technology. So again, it's constructive. The third thing that comes up a lot, and I think it's a good something to get out there and so people understand the difference between carbon and some other markets, is people remember oil futures. And I remember 10 years ago, because I was running an oil fund at the time, people bet that oil would go up, and they were right. But they actually still lost because the cost of contango, the role of the futures, was more expensive than what they made. And so the thing to point out and be clear on here is that in the oil market, there are real costs to that position. There are logistics of oil tankers, maintaining pipelines, the people you need to move that oil around. That's where that steep cost was coming in. And in a carbon credit, this is literally a digital entry that is moved between accounts, more like a stock. So considerably flatter curve. It's more a financial funding cost of carry rather than that logistics. So much lower exposure to that. And also we generally roll about once a year through these futures. So we're not rolling every single month like some of those oil funds were at that time. So very different indeed. But it's a great question, and we're happy to discuss it with people.
Yeah, no, you laid out the three risks very, very well. As we wrap up, I want to make sure that podcast listeners know you can learn more about KRBN by visiting KraneShares.com. Luke, I wanted to give you an opportunity to talk a little bit about your firm, KraneShares, the value proposition for advisors, and some of the products that you might like to highlight for advisors.
Certainly. So KraneShares is a global asset manager. And we have a keen focus on China through our ETFs, our model portfolios, and really focused on where China and emerging markets fit in a forward-looking portfolio. Just the underweight to China right now and the economic significance of China is a real focus for us. The other area that we focus is on these innovative first-to-market diversifiers like KRBN and like IVOL and KMLM, for example, on the managed futures side, that really offer something to the market that they're not getting elsewhere. And so I probably should, just switching back over to the China side there, we have a core A-shares product. There's an article you're showing there that's worth a read about the move of money into mainland China that's kind of going unnoticed, which is the A-share market, which is very untapped and underweight. So something that KBA is a ticker to look at for that. The other one is our flagship product, KWEB, and it's been on the receiving end of some of this recent sell-off that we've seen in Chinese tech names. So definitely something to look at there as well.
Excellent. Visit KraneShares.com. That's KraneShares.com to learn more information about those products and, of course, KRBN. Luke, I really appreciate you coming on the show.
Thanks, Jay. Thank you.
Are you struggling to hold your team accountable? Do you struggle getting them to see your vision and drive results? The Resilient OKR system for financial advisors could be your solution. OKR is an acronym for Objectives, which are your big inspirational goals, and Key Results, which are how you and your team are held accountable. This is the Silicon Valley method that drives growth at major companies such as Intel, Google, BMW, and Disney. Move your business results away from opinions and measure it with data.
Pick up your complimentary access to the Resilient OKR system for financial advisors by visiting resilientadvisor.com/OKR.